Hey everyone, welcome back to Corporate Decoder. Today DCI just filed their quarterly report for April 2026 and I am seeing some interesting shifts in their business. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company appears to be navigating a dynamic economic landscape, which has led to some mixed but mostly positive financial results this quarter. Let us dive right into the numbers. This filing gives us a look at their financial health over the past few months and compares it to last year. Looking at the 3 months that ended on the 30th of April 2026, net sales were up to $995.1 million. That is a nice jump from $940.1 million in the same period last year. And net earnings really got a boost. They jumped from $57.8 million last year to a whopping $118.1 million this year. That is more than double. This translates to diluted earnings per share of $1 up from just 48 cents last year. That is a fantastic improvement for shareholders. Now let us look at the 9-month period, so the first 3 quarters of their fiscal year. Net sales also grew, reaching $2,826.8 million compared to $2,710.2 million last year. And net earnings for the 9 months were $324.5 million. A solid increase from $252.7 million over the same period last year. Diluted earnings per share for the 9 months came in at $2.75, up from $2.09 last year. This shows consistent growth throughout the year. Now let us check out their balance sheet, what they own and what they owe. As of the 30th of April 2026, their total assets were $3,087.5 million. Total stockholders' equity also saw a nice bump, climbing to $1,695.3 million, up from $1,453.5 million in July of 2025. This indicates a stronger financial position. When we look at cash flow, the company generated $293.8 million from operating activities for the 9 months ending the 30th of April 2026. That is up from $251.0 million the prior year, showing they are bringing in more cash from their core business. Their cash on hand also increased, ending at $204.1 million, up from $180.4 million. This gives them a good cushion. A big story this quarter is an acquisition. In May 2026, Donaldson bought Filtration Group's Facet filtration business for about $828.7 million. This is a significant move to expand their offerings, especially in fuel and fluid filtration for aerospace and defense. This acquisition will likely impact their financials moving forward, especially with the increase in debt. Inventories remain stable at $535.9 million for finished products, raw materials, and work in progress. This suggests they are managing their stock levels effectively. Goodwill, which represents the premium paid for acquisitions, stands at $499.4 million. This is up slightly from $493.6 million last year, mainly due to foreign currency translation. They are not showing any signs of goodwill impairment, which is good. Donaldson breaks down its business into 3 main parts: mobile solutions, industrial solutions, and life sciences. Mobile solutions is doing quite well, with sales up to $629.9 million for the quarter. This segment really drove the overall growth. Industrial solutions saw a slight dip in sales, coming in at $281.7 million compared to $283.3 million last year. This might be due to some supply chain issues or shifts in demand in certain industrial sectors. Life sciences is growing, with sales up to $83.5 million from $74.2 million. This shows strong demand in areas like food and beverage and medical. Looking at the overall operating results, the increase in net sales for the 3 months ended the 30th of April 2026 was driven by favorable foreign currency impacts, pricing increases, and volume growth. This is a positive sign of broad-based strength, though some segments are performing better than others. However, their gross margin as a percentage of net sales slightly decreased to 33.5% from 34.2%. The company mentions this is due to some increased costs related to restructuring efforts and operational changes in their industrial solutions segment. Selling, general, and administrative expenses as a percentage of net sales actually improved slightly, showing good cost management. A big positive change is the absence of a loss on impairment of intangible assets this year. Last year, they had a massive $62 million hit related to their bioprocessing business, which is not repeated this quarter. This is a significant improvement to their bottom line. Their effective tax rate was 23.7% this year compared to 33.6% last year. This lower rate, especially when you remove the impact of that impairment charge from last year, is a good sign for how much of their earnings they get to keep. On the liquidity front, Donaldson seems to be in a strong position. They have $204.1 million in cash and cash equivalents. They also have over $1.2 billion available under their credit facilities, giving them plenty of flexibility for operations and future investments, like the recent Facet acquisition. The company continues to buy back its own stock, repurchasing 1.4 million shares for $108.5 million in the 9 months, ended the 30th of April, 2026. This is a way to return value to shareholders, though they did scale back repurchases compared to the previous year, likely in preparation for the Facet deal. The big news for sure is that Facet acquisition that closed on May 4th. This is a strategic move to boost their offerings in critical filtration markets. This acquisition definitely raises their debt. They took on about $820 million in new debt, bringing their total debt to around $1.4 billion. This means their debt to equity ratio will be higher, and they will have more interest expenses to manage. Now, looking at the risks, the Facet acquisition brings its own set of challenges. Integration could be complex, potentially leading to higher operating costs or disruptions. There is also the risk of undisclosed liabilities from Facet, which could prove costly. The company also faces market risks like changes in currency exchange rates. Their global operations mean they deal with different currencies, and a stronger dollar can hurt their reported earnings when converting foreign sales back to dollars. They are using strategies like currency forward contracts to manage this risk. Overall, Donaldson seems to be executing its strategy well, with solid sales growth and improved profitability in the reported periods. The expansion through acquisitions like Facet shows they are investing in their future. However, the increased debt from this recent purchase will be something to watch closely. The key for them will be successfully integrating Facet while managing operational costs and leveraging their global footprint to offset market fluctuations. The risk I am watching is how well they can integrate Facet without major hiccups and manage the increased debt burden. What I am actually looking for is sustained profit margin improvement across all segments. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like and subscribe if you found this valuable. Join our Discord.